Global Minimum Tax Part 6. Disclaimer. The following information is intended only to be a guide. It must not be relied on in or applied to specific situations without seeking proper professional advice. This material is prepared by appropriately adapting the content provided on the Global Minimum Tax Portal produced by the National Tax Service of Korea in 2025. As you see, the global minimum tax regime is very complicated and difficult to apply actually. So there is some transitional relief. Overview of the regime. Pursuant to Article 80 of the AITA, Adjustment of International Tax Act, if a jurisdiction satisfies the requirements for transitional relief, the reporting constituent entity may elect to treat the top-up tax attributable to that jurisdiction as zero. This is exemption of tax and reporting requirement. Eligibility requirements: when one or more of the following three conditions are met. Number one is do de minimis test. Number one, there are three conditions which should be met for applying the transitional relief. But there is no need to meet every requirements. Only one of the three is okay. So if only one condition will be met, then the transitional relief will be given. So number one is the minimis test. Small amount test. The total revenue of the jurisdiction reported in CBCR, country by country report, is less than 10 million euro. And at the same time, the total income before tax on the CBCR, country by country report, is 1 million euro or under. 1 and 2, this is the minimis test. Number 2 is simplified effective tax rate. The simplified effective tax rate calculated for the jurisdiction must meet or exceed the threshold of, in 2024, 15%, 25, 16%, and 26, 17%. This is the simplified effective tax rate test. And number 3 is the excess profit test. The definition of excess profit is global income minus substance-based exclusion. And this substance-based exclusion is payroll cost from 9.8% to 5%, annually reduced, and tangible asset book value 7.8% diminished by to 5%. Okay, but the global income is smaller than substance-based exclusion. Then excess profit will be zero or negative. In this case, naturally, there is no need to compute GMT. So in this case, there is no need to file the GMT return. So the transitional relief will be given. And then applicable period. Applicable period is The transitional relief applies to each fiscal year that begins on or before December 31, 26 and ends on or before June 30, 2028, the transitional fiscal years. This means that, for instance, the fiscal year end is like December 31. Then they have the fiscal year January 1st to December 31, 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 okay? And which begins on or before and begins and ends on or before June 30, 2028. So fiscal year 24, 25, 26, 27 will be applied. In this case, the company constituent entity shall elect for the exemption of the payment. Okay, and then penalties. Penalty. This is very. We have to apply. Afraid of the penalty. Number one is. Number two is penalty by AITA, Adjustment of International Tax Act, and number one is Framework Act on National Taxes. National taxes. The penalty by AITA, this is very big. When the company ignore to file the information report, for instance, Form 53 and 54, or Form 55. Okay, so the company is eligible for the Form 55, a simple form on page 2 page simple, and then this is very complicated. Page 56 to 65 pages. Okay, if the company does not eligible for Form 55, then that company should submit the Form 53 and 54. If that company is eligible for a simple form, Form 55, for instance, other constituent of the outside of Korea has do the submission, then the submission to Korea's tax office is exempted. But in that case, we have to pay the Form 55. The name is Global Information Return relating to overseas constituent entities. So, in any case, the one A or B should be filed and submitted. If failed, the penalty is $68,000 US. Korea won 100 million Korea won. This is huge. I think that this is ridiculous. This should be reconsidered. And Framework Act is applied to every tax items of Korea: corporation tax, value-added tax, individual income tax, and everything. So it is, if the company is liable to file GMT return, global minimum tax return, but company do not file, no file, then normally 20%, but the company has some fraudulent thing like hide some evidence or some very non-cooperative with the tax office, then 40% will be applied to the tax. And number 2 is like a partial fine, or the amount is smaller than which should be filed, then in that case normally 10%. But if there is some fraudulent event, then 40% will be applied. So, okay, so this is based on Framework Act on National Taxes. For failure of the regular filing of tax return, this kind of penalty will be assessed. And finally, the Korea portal, the GMT portal, is showing the list of the countries which apply the QMDTT, which apply the QD domestic, QDMTT, IIR, UTPR, and exchange of tax information between countries. So QDMTT, for instance, Spain and Germany and many other countries. IIR is Spain, Germany, and many other countries. And the UTPR, Spain, Germany, and many other countries. Exchange of tax returns, Spain, Germany, and many other countries. I mentioned Spain and Germany because I have a client whose parent company located in Spain, whose parent company located in Germany. So I'm very I want to seek whether these two countries, Spain and Germany, is applying the GMP or not, but they apply the full QDMTT, IIR, UTPR, and exchange of information. Spain and Germany is a exemplary country in terms of global minimum tax. But as I mentioned, the main player, United States of America, China, and India, they still have not joined the global minimum tax. I explained briefly about the global minimum tax based on the material which is provided by the National Tax Service, and then I think that this is new and this is very complicated, so I think that my series of upload will be helpful to the tax consultant or tax practitioners. Thank you very much.